Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing UnitedHealth stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. UnitedHealth is an insurance and healthcare company. It is the largest U.S. healthcare company in terms of revenue and the largest insurance company in terms of premiums. The company is headquartered in Minnetonka, Minnesota, and was founded in 1977. The ticker trades on the New York Stock Exchange, Deutsche Borse, Mexican Bolsa, London Stock Exchange, Xetra, Vienna, EuroTLX, Sao Paulo, Buenos, and Santiago Stock Exchange. Let's get started with the model. This is a large cap company, 471 billion market cap. They're trading at 501 a share, and they have 939 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. This company's rolling into cash. Look how much cash flow they have. Over 19 billion in the trailing 12 months, 20 billion in 2020 and 2021. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that peaks in the trailing 12 months at close to 18 billion. Revenue is a sales for the company, and that's nearly 300 billion in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grows each year from 56 billion to 69 billion. Below that is our operating expenses. These are all of the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that grows each year from 18 billion to 22 billion. Below that is the interest they pay in their debt, which is 1.7 billion, a little lower than 2019, a little higher than 2020 and 2021. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. The gain on the sale of an investment is an example of something in this category. Then your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is close to 18 billion, higher than 2019, 2020, or 2021. Here's the company's income statement directly from their website. The first quarter of 2021 and the first quarter of 2022. Their revenue was 70 billion, now it's up to 80 billion. They served 51 million customers in the first quarter, which is slightly more than last quarter, 1.5 million more than the first quarter of 2021. 8,000 customers are risk-based, 18,000 fee-based. Fee-based is the most common model used in this industry. In this model, the doctors are reimbursed from the insurance companies on whatever services they provided. Risk-based is done through bundled packages, so the healthcare provider has to provide more efficient care. They have over 19 million members on Medicare and Medicaid, and 5.5 million outside the US. They receive a bulk of their revenue from premiums, 64 billion. If you receive this company's insurance, then your monthly premium is part of this bucket. Over 9 billion from products and 6.4 billion from services. Their biggest expense by far is medical cost at 53 billion, operating costs 11.4 billion, cost of products sold 8.5 billion, and depreciation and amortization 800 million. Their operating income is up from 6.7 billion to 7 billion. They paid more interest on their debt in the first quarter of 2022 compared to the first quarter of 2021. Their net profit was 5.1 billion. It was 5 billion. Their EPS is up 19 cents from $5.08 to $5.27. Their diluted earnings per share are down from 957 million to 954 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They also spend a lot on CapEx. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they have tons of free cash flow, so they do pay a nice dividend. They also buy back lots of stock, 5.9 billion, 5 billion, 4.3 billion, 5.5 billion. When a company buys back common stock, it decreases the shares outstanding and makes your shares more valuable. The two main ways to reward investors are to pay a dividend and to buy back stock. This company does both. They seem to add debt each year. They added $7 billion of debt in 2021, paid down $3.1 billion. So they increased their debt load $3.8 billion in 2021. They increased it $1.7 billion in 2020 and $4 billion in 2019. You may be thinking, why does a company with so much free cash flow add debt each year? It's to acquire other companies. You can see how much their investing cash flow is. That's where acquisitions go. In the first quarter of 2022, they generated $5.3 billion of cash flow. Their net earnings was $5.1 billion. We add back depreciation and amortization, stock-based compensation, and we adjust for changes in working capital. In their investing section, they acquired $1.6 billion of investments. They spent $555 million in CapEx, and they spent $1.2 billion on acquisitions. Same thing last year in the first quarter, $1.2 billion in acquisitions. In their investing section, they had a cash outflow of $3.7 billion. In their financing section, they bought back $2.5 billion of common stock. This is just in the first quarter. They paid out $1.4 billion of dividends, and they added $2 billion of debt. So in their financing section, they had a cash inflow of $2.3 billion. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. And look how much their revenue goes up. Every single year it goes up. That's what you like to see when you invest in a company. And their operating cash flow is pretty steady year to year. Let's look at the capital structure. $76 billion of equity, $47 billion of debt. They're 62% equity, 38% debt. And they could pay off a bulk of their debt with the cash on their balance sheet if they wanted to. Their net debt is $19 billion. This blue line is their equity balance since 2015. And look how much it goes up each year, close to $80 billion in 2022. Their debt balance is always below their equity balance, and they always have lots of cash on their balance sheet. That's the green line. I gave them the highest whack on Finbox, 7%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $654 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $585 billion. We divide that by 939 million shares. And we get a calculated stock price of $623. They're trading at $501, so they're trading at a 20% discount. It's a buy according to the model. The last time I did a video on this company was in June 2020. I started the channel in May 2020, so it was one of my earliest videos. So you can see the stock has grown a lot since I made this last video. Their revenue target for 2024 is $378 billion. For 2023, it's $346 billion. For 2022, it's $321 billion. And to calculate their 2025 revenue, I grew it at a similar pace as the prior years. And I got $409 billion. They convert on average 7% of their revenue into free cash flow, so I multiplied their future revenue estimates by 7%. That's how I got their future free cash flows. The website Simply Wall Street is a lot higher than me. They're at $8.50 a share. They're saying it's 41% undervalued. 17 analysts priced this stock, and the average price target is $587. The low is $485. The high is $665. This is where the stock has been trading the last 5 years. The stock price has pretty much only gone up the past 5 years, plus you get that quarterly dividend. So if you own this stock, you're pretty happy. Unless you bought the stock within the last 2 months, because there was a pullback of about 10-20%. They pay a quarterly dividend of $1.45, which is a yield of 1.16%, 30% of their net income, 28% of their free cash flow. Their quarterly dividend is around 1.5% for the past 10 years. The projection is for their dividend to be 1.4% by 2024. Their beta is 0.88, so the stock moves a little less than the market. It's gone up 25% in the past 52 weeks, while the S&P is down 1.5%. The 52-week low is 383, the high is 553. And the stock is trading between its 50-day and 200-day moving average. 3 million shares are traded each day on this stock. Of the 939 million shares outstanding, 936 million are on float. 90% are held by institutions, and 0.5% of the shares are shorted. The company has done 5 stock splits, all 2-for-1s in 92, 94, 2000, 2003, and 2005. Their employee count has gone up a lot since 2016. They currently employ 350,000 people. 89% of the company is held by institutions. 10.5% by the general public, and 0.5% by individual insiders. In the past 12 months, there's been lots of insider selling, very little insider buying. Here's a list of all the insider selling and buying, the date, the person, the number of shares, and the price. Most of these people would have been better off waiting because the stock price is pretty much above all these sell prices, except for the very last sale on March 23rd. That's higher than today's price, but all the other ones are lower. This orange dotted line is the company's earnings. The CEO's salary in 2021 was $1.45 million, and their total compensation was $18 million. And their earnings were $17 billion. If you invested $10,000 into this company 10 years ago, you'd be really happy at over $100,000 today. That's a 27% annual return. Vanguard is the biggest shareholder at 8.5%, then Capital Research, BlackRock, Fidelity, and State Street. Let's look at their financial ratios. Their PE is 26, that's stock price over earnings per share. A really good price to sales of 1.6. And a price to book of 6.2. Their price to free cash flow is 24.5. That's stock price over free cash flow per share. Let's look at their non-current assets. 42 billion of long-term investments and 110 billion of other. Let's look at their non-current liabilities. 41 billion of long-term debt, 14.6 billion of other, and 1.5 billion of redeemable non-controlling interests. They have a really high return on invested capital of 18%. They can cover the interest payments with their operating income 13 times. A really good ROE of 24%. They can cover 80% of their current liabilities with their current assets. Same thing with the quick ratio since they have no inventory in their balance sheet, 0.8. Let's look at their current assets. 28 billion of cash, 19 billion of receivables. This is how much money is owed to them, and 22 billion of other. Let's look at their current liabilities. They owe 29 billion in medical costs, 7 billion in short-term debt that's due within the next 12 months, and 53 billion of other. They generated over 19 billion of free cash flow in the trailing 12 months. Their working capital is negative 19 billion, and they pay out 5.5 billion of dividend payments. So it looks like they're going to be short $5.4 billion. So they will need to add some debt over the next 12 months just to run their day-to-day business. The best way to look at ratios to compare them to companies in the same industry. There are 13 companies in the same industry as UnitedHealth, and if they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend a lot more than average in CapEx. They have a better debt to equity ratio. Their dividend is higher than average because a lot of companies in this industry do not pay a dividend. They generate the most free cash flow. They're the largest in terms of market cap. All their price multiples are worse than average. It's good to look at price to book when you value an insurance company, and their price to book isn't so great. So this would indicate maybe the stock is overvalued, even though my model says it's undervalued. They generate more revenue than any other company, a little more than CVS. They're not growing as much as the average company, only 8%. The average is 32%. They have the best ROA of all the companies, that's net income over assets, and the second best ROE, that's net income over equity. So to summarize, I have them trading at a 20% discount, but this company is a monster, and insurance is something we always need. There's so much demand, especially for medical insurance. This company is a cash cow that's a great long-term hold. I rank their free cash flow 7 out of 10, their revenue 10 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching. Fee-based is the most common model used in this industry.